Welcome back to Turning Hard Times into Good Times. I am pleased to have with me once again John Rubino. John runs the popular financial website dollarcollapse.com. He's the author with Gold Money's James Turk on a book called The Money Bubble, What to Do Before It Pops. He's written many other books as well, and he is an author, writes for some prestigious publications such as TheStreet.com. He's also writes for the CFA magazine and other such prestigious publications. Thank you for joining me again, John.
Hi, Jay. Good to be back.
Good to be back, and thank you so much for stepping in. I was so grateful to you for being able to take David Stockman's place today, and also thanks so much for hosting my show a couple of weeks ago. It allowed me to make a trip to Nevada and visit a very interesting gold mining project there. So thanks very much for all of that. You know, we've titled today's show, Return of the Bond Vigilantes. What does it mean for the markets? And maybe I would just like to ask you to define a bond vigilante and what purpose do they serve?
Well, sure. Back in normal times, which is to say pre-1990s, the bond market was kind of a limiting factor on financial mismanagement on the part of governments, because once governments started borrowing too much money or encouraging their citizens to borrow too much money, the people who would normally buy bonds would lose their interest in something that pays a fixed number of pieces of currency year after year, because the assumption would be that all this debt that's being taken on by the rest of the country would make the currency less valuable. You know, we'd have to create a lot of new dollars to pay off all the interest on the new debt we're taking on. And that would make the bond market skittish. Bond prices would go down, interest rates would go up, and that would stop the aggressive leveraging of the government in its tracks. That stopped in the 1990s when we were taking on huge amounts of debt, mostly via the dot-com bubble at the time. And the Fed was still intervening aggressively to stop any kind of a little, incipient crisis in the market. They did it over and over again.
Right.
And by doing so, they sent the market a message that don't worry. Go ahead and keep buying bonds because the central bank is going to keep pushing interest rates down no matter what. And so we had a stretch of 30-some years, since the 80s to basically last year, in which interest rates went down every year. And so the bond vigilantes were basically hamstrung. The bond market was no longer a limit on the amount of debt that a system could take on. And, surprise, surprise, we took on immense amounts of debt while that was going on. Once we didn't have any adult supervision from the bond market, the rest of the economies of the world, and it's not just the U.S., it's all the major economies of the world, took on unprecedented, one would say crazy amounts of debt, which, puts us where we are now in a situation where we're so fragile that any kind of a crisis, whether it's exogenous, some kind of geopolitical thing, or within the markets, a garden variety bear market in equities where they drop 20%, anything like that is systemically threatening now. And that should be terrifying to everybody who has money at risk, because, you get stuff like that every once in a while. There will be a war. I'll go out on a limb and say there will be a really scary war in the next decade, and that there will be extreme fluctuations in the financial markets this year, as we're seeing already, and going forward. And that kind of stuff used to be something that the markets could handle. Probably not anymore. And so that's a huge change if you've got any money at risk, because now it's really at risk.
John, how is it that the U.S. could behave that way, that the central banks around the world could behave that way? How is it that they have been able to defy the natural laws of supply and demand for money? It doesn't. How is it that confidence has been maintained when you've had the U.S. deficit for the U.S. debt, for example, going up from somewhere less than $1 trillion when David Stockman was with Ronald Reagan in 1980 to $20 trillion and rising very rapidly now?
Yeah, well, you can trace it back to 1971 when we broke the final link between gold and the world's fiat currencies. It used to be that money was a real thing. It was gold. Mm-hmm. And if you wanted to, say, wage a big war or radically increase some kind of social spending or pretty much anything else that cost a lot of money, you had to go out and get gold somehow. And it's not easy to do that. You have to dig it out of the ground. And, traditionally we get about 2% more gold each year by doing that, which limits the supply of that kind of money. Mm-hmm. And so we had low inflation for most of the past several centuries because the supply of the base money, gold, was only rising at 2% a year. In 1971, we did away with that. Governments wanted more flexibility to be able to massively increase military spending, for instance, in the case of the U.S., or to dramatically increase entitlements, also in the case of the U.S., but also everybody else in the world. And so they did that. Now, the central banks at that point, when they have pure fiat currencies, are armed with, effectively unlimited credit cards. They can make as much new currency as they want to. And so since the time that we became pure fiat currencies, the central banks have intervened in the markets using this unlimited printing press to distort normal market mechanisms. We started with the Bond Vigilantes here. They basically shut down the Bond Vigilantes by creating trillions and trillions of dollars and euros and yen and buying back bonds with them, which pushed the price of bonds down, which means it doesn't matter if the markets are a little bit skittish about inflation and they're selling their bonds. The central banks are there to buy them at ever lower interest rates, at ever higher prices. And gradually, people have gotten used to that. They started to think that that's the new normal in the world, where central banks basically just control what used to be free markets. And so stocks will always go up, home prices will always go up, bond prices will always go up, which is to say interest rates will always go down, or at least they'll stay at really favorable low levels. So why not borrow as much as you can get a hold of? If interest rates are super low and the Fed is going to maintain stability in the markets, borrow a ton of money, because you'll be able to pay it back especially at these lower interest rates. So the whole world basically has gone on a debt binge since then. And that's how they've been able to get away with it. We think the central banks are omnipotent, that they can maintain 2017 levels of financial stability forever. But what we're finding out lately is that maybe that's not true. All of a sudden, the stock market is bouncing around really dramatically. Bonds are starting to go down pretty hard as interest rates go up. We're down, I think, about 270 points on the Dow today, Jay. As we're talking.
I noticed. Uh-huh.
And 3 months ago, a 270-point move on the Dow would have been really remarkable. It would have had people, sitting up and paying attention. And now it's like, it's not even 500 points, and certainly not 1,000 points. So it's just random noise. Who cares? That's how much volatility we've gotten into the market just in the last couple of months. And that's how quickly everybody's gotten used to this volatility.
Right. Well, let's explore some of the ways and some of the reasons why the Fed may not be omnipotent and omniscient, why, in fact, there may be some limits to what the Fed can do and how far they can manipulate markets, why it is maybe, just maybe, that the natural laws of economics have not been overcome by, these brilliant guys from Princeton, Harvard, and Yale that run our country and run our banking system. What are some of the reasons? I mean, one of the things I can think of right away, John, is that you have malinvestment that's caused when you don't allow the capital to be priced correctly, when you don't allow price discovery of capital, you push the price of capital down, then you have something the Austrians refer to as malinvestment, when money goes into all kinds of things that don't make really any economic sense. Is that one of the problems that the system is going to be facing now? You have all of all of this capital put into places that don't really provide great returns?
Yes. The short answer is emphatically yes. What happens when you make money too cheap is that people misread the signal that you're sending. If banks want to lend you money at extremely low interest rates, normally that's kind of energizing, right, for anybody. And your tendency is to say, well, if they think I'm such a good credit, let me borrow this money and I'll find something to do with it. So you get the whole world basically doing that when everybody's pushed interest rates down to really low levels. And then you get things like in China, for instance, ghost cities, where they build entire cities because they have access to the funds at very cheap rates. Mm-hmm. And nobody lives there now. And the same thing with airports and highways. They went on this infrastructure building binge over the last decade, which caused them to quintuple their total amount of debt in the system, and they probably didn't get a good deal because they built a lot of things that will never generate the kind of cash flow necessary to pay off the debt. And that's true everywhere. If you look at, for instance, the corporate sector in the U.S., corporations have borrowed record amounts of money, but instead of doing productive stuff with it, in other words, building a new factory that'll produce something that'll generate massive cash flow and pay that debt off with no trouble, they've been buying back their stock or paying dividends. And so what's happening now is the stock price is up somewhat, which makes the rich people who own the stock and the corporate executives who own a lot of the stock even richer than they were. But you've got this company that's saddled with huge amounts of debt, record amounts of debt, 8 years into a recovery. Economic expansions don't normally last more than 6 years. and then there's a recession to flush out all the malinvestment that happens towards the end of a recovery. Well, we're towards the end of one of the longest recoveries ever, and corporations are borrowing record amounts of money to buy back their own stock at record high prices. Now, that you can think through the implications of that and see that that's a big problem for a lot of corporations, which we don't realize. We're not recognizing that in the company's stock price because the stock price is being pushed up by all the money that companies are borrowing to buy more stock. But once the economy turns down or once interest rates go up, and it's no longer a good deal for companies to start or to keep borrowing money to buy back their stock, then that huge buying pressure that's there now will disappear, stock prices will go back down, and these companies will be stuck with all the debt that they took on, but assets in the form of the equity that they bought back that's only worth half as much. Yeah. So they're gonna be looking at a 50% loss on what is probably, in a lot of cases for these guys, their biggest activity. Buying back stock is the biggest thing they do now. And when that happens, they're going to look like badly managed hedge funds rather than brilliantly managed industrial companies.
Right.
And so their stock prices will just go down. It'll be like a death spiral where stock price drops because of the recession. And then we see all the problems that this company actually has laid bare, and we sell the stock some more, and it drops even further. That's out there. That will happen in the next few years.
Yeah, what is the saying? When the tide goes out, you find out who's swimming naked or something like that?
Yes.
So then you have, and the other thing, John, is that you have this enormous amount of debt. I mean, people, we don't, as you said, gold used to be money, still is, but it was legal tender in the United States, and so it was an asset-based money, whereas now it's a liability-based money. So all the debt is still there. It's not, most of it, I guess, every now and then it goes through bankruptcy and gets forgiven or disappears that way. But for the most part, you have this exponential growth in debt, and then you have the compounding effect of that even under low rates of interest. I've noticed a chart the other day that showed even as rates were falling, U.S. debt, Treasury debt was going up fairly significantly. And now as rates are starting to rise, can you imagine? Michael Oliver was telling us that he's expecting, his work is suggesting very strongly we're going to see 4.25 on the 30-year. Can you imagine? I don't know. On shorter duration there will be lower rates probably, but do you see what is this going to mean for the Treasury? And then we have a new we have a new guy at the Fed, Jay Powell. What do you think he's going to do? Do you think he'll handle things any differently than Janet Yellen might have, or Ben Bernanke when push comes to shove, when we, as this rate rises, as rates rise, which I think they inevitably will because there's a shortage of capital to meet the enormous amount of indebtedness that our government is piling up. How do you think, do you have an opinion on how Jay Powell may handle this, and what do you think the outcome is going to be here?
Well, whoever's running the Fed, first of all, they all come from the same pool of people, right? Who talk every day and who agree on everything. So what the new Fed leadership will do will be identical to what the old Fed leadership did in the previous crisis, except it'll have to be a lot bigger because the numbers are a lot bigger. We owe way more. So in order to monetize that debt, we've got to create even more currency. So when this happens, we'll see quantitative easing on a scale that dwarfs what we had before. We'll see interest rates go not just to zero, but sharply negative in a lot of the major countries. There was at one point, what was it, $30 trillion or something like that of negative yielding sovereign debt. out there in the world.
Yeah.
And now there's much less because interest rates are starting to go up into positive territory. And that is the embedded time bomb in this kind of a system because everybody's deeply in debt. And in a lot of cases, they borrowed very short term in order to get the lowest rate, because short-term rates were even lower than extremely low long-term rates for the past few years. So you got all these governments that have to roll over trillions of dollars a year, every year, of just their existing debt. At the same time, they're borrowing new money. So if interest rates go up, you get a double whammy. The debt you roll over costs you more, and the new debt that you take on costs more than the old debt did. And so your interest costs start to ratchet up. And we're not talking just a few $100 billion here or there. We're talking trillions of dollars of new interest costs that are embedded in a system where the long bond does what you were saying. If it goes over 4%, that sounds existentially threatening when you look at the numbers. So there's a number out there, Jay, on the 10-year or the 30-year bond that blows up the system. And we don't know what that yield number is. Maybe it's 3% on the 10-year bond. Maybe it has to go to 4%. If it goes to 5%, the numbers become so forbidding that I think the number is before 5%. But somewhere out there is an interest rate number that blows up the system. And it is probably not that far away based on the amount of debt that we've taken on. So the short takeaway from all of this is that the volatility we've seen lately is just a taste of what's to come. It's going to be much more extreme before this plays out.
And at some point in time, your website is dollarcollapse.com. It's there. You've named it that for a reason. Your view is at some point in time, confidence comes into play. At what point in time do people stop believing that these brilliant PhDs from Princeton, Harvard, and Yale that run our country, run our banking system, are not omniscient, are not omnipotent? When do people, at some point, maybe when this system blows up, what happens then? And do we run into a hyperinflationary event or a deflationary implosion? What's your best guess?
Well, it could be either of those because immense amounts of debt can lead either way. You could have a 1930s style collapse when we get rid of the debt by defaulting on it, or you can have a Weimar Germany style hyperinflation that gets you out from under the debt by inflating it away. You still pay off your debts, but you're paying it off in currency that's worth 1/30 of what the original currency was. It's clear that we're going to try to engineer a big devaluation. That's what we're going for now. Everybody's trying to make their fiat currencies worth less and less each year in the hope that keeps them ahead of their mounting debts. The huge danger there is that people figure it out. Once everybody realizes that it's the policy of the government to make the money in their bank accounts and the money in their wallet and under their mattress and buried in the tin can in the backyard worth less each year, nobody wants to hold that money anymore. It makes sense to borrow as much as possible and then to convert all that money that you get into real stuff that governments can't inflate away. So the Austrian School of Economics calls that a crack-up boom. And we've created the classic conditions for that to happen. And then it just becomes a question of timing, right? Is it this year, next year, 5 years from now? We can't know that. But we can say with a high degree of certainty that something pretty terrible is going to come from this much borrowing because we've got 3,000 years of history with absolutely no exceptions in which countries that borrow too much money had a gigantic financial crisis involving their currency. That's happened over and over again. So there's no reason to think that it won't happen this time around.
Yeah. We're just about out of time, but I have to think here that, you're talking about when people figure it out. Right now, it seems like the safest thing in the world. Governments are increasing their money supply to try to beat this thing. And gold is one of the few places, one of the most logical places to go. I guess at some point in time, people lose confidence, then velocity kicks in. Then you could go over to the hyperinflation side, John. We're 30 seconds. We're out of money. We're out of time here.
Okay, hyperinflation this time around. or mass devaluation or crack up boom, whatever term you want to use for it, will manifest as the value of the dollar and the euro and the yen starting to go down big against real things, which means the price of real things will go up. Gold and silver will go parabolic while this is happening. Yeah. $100 up days for gold, $10 up days for silver regularly for a while. Yeah. It'll be fun to watch from a gold bug's perspective.
Yeah, but not a very safe environment for sure. So thank you, John, for being with us today on that unhappy note in a way. But it's always good to have you with us to get your thoughts on these very important issues. So thanks very much for being with us.